Alrighty, we are exactly 48 hours away from Powell's FOMC speech or FOMC decision. I think the market's priced in the fact that Powell's probably going to increase rates by 25 basis points. And then I guess the market has priced in that this is the last interest rate hike before we keep interest rates stable and then eventually maybe in March actually start reducing interest rates. Now, when it comes to Bitcoin, we've been in this very awkward place because for the last month, Bitcoin has been trending sideways with no volatility. About 48 hours or just longer than 48 hours before the FOMC decision, Bitcoin decides to break down and for the first time, we start getting some volatility. And I think that this is the volatility that all the expert traders are starting to trade. So they don't trade well when there's no volatility, but when there is volatility, that's the volatility they start to trade. And when they do trade this volatility, they don't trade it using spot and they don't trade it using futures or derivatives. But what they trade it using is they trade it using options. So today, what I want to do is I want to spend some time teaching you guys how to be like the expert traders, how to use options to trade big events like the FOMC, but also how to use options to hedge your portfolio and just to become a more sophisticated trader. So it's going to be a fun show. I'm glad to be back. I've been away for a while. I'm glad to be back. I'm glad to be back on the week of FOMC. Let's do this. Let's become expert pro traders. Look, I'll tell you one thing. I'm not happy about the direction that Bitcoin went in, but I am happy that there's some kind of movement in the Bitcoin market, because if we carried on for another month with this sideways, no volatility action, I think I would have died of boredom. At least now it's going down, and hopefully this is like one move down before the move up. And if you have been looking for volatility, I guess this is going to be probably a big week for volatility, not only on the crypto markets, but actually on the traditional stock markets as well, because we've had the NASDAQ on a tear since the beginning of the year. We've spoken about this quite a bit, but if you look at the NASDAQ and you look at it since January, you have the NASDAQ up about, I'm not being very accurate here, but you have NASDAQ up about 44%, which is, that's a tear over a year. And it started to come down. A lot of people are saying, okay, this is the beginning of the big come down in the NASDAQ. We have the Fed meeting on Wednesday. And at the Fed meeting, of course, there's a 90 or let's say this 98.9% of people expect a 25 basis point rate hike. 1.1% expect a 50 basis point rate hike. So, that's where it is. And people are also saying that this is probably going to be the last rate hike of the year, or at least the probabilities are that it's the last rate hike of the year before we start reducing rates next year in March. So I think today we're going to talk about how to trade the FOMC. There's definitely going to be a lot of volatility. And as I said to you, when the experts trade, when the big funds trade, when they want to hedge their positions, they trade using options. They don't trade using leverage futures because they don't want to get wiped out or liquidated, which is what happens to most retail traders when they use futures. But they use a much more sophisticated instrument, and they use options. And this video, of course, is brought to you with our partners, Deribit, and this is the biggest options exchange. All the trading that we're going to do on options here is going to be done on Deribit. And I think it's very important that you open an account, you sign up on the account, and I think you get a $50 sign-up bonus once you've been KYC to actually start teaching you guys how to use the option. So that's the first thing you need to do. There's a link at the bottom of this video. Hit that link, sign up so you can get trading with us. And for those of you who weren't here last time when we did one of these options things, let me tell you, it was super educational, super informative. So, and I've got the same two guests with me today. I've got Richard and Shane with me today. But before I bring them on, I just want to do like a options 101 for dummies, for those that have missed the last options tutorial that we did, just so that you don't feel too lost when we're navigating this thing. Cool. So let's get into it. Again, just for those of you who don't know what an option is, I made a little presentation. I haven't done presentations since high school, but I guess this is probably a good time to show you guys a little presentation. So what is an option? An option is exactly what it sounds like. It's an option. It's the right, but not the obligation to buy and sell an asset at a set price at a future point in time. So effectively, if you translate this to crypto, you say you have the right to buy or to sell Bitcoin at a certain point in time at a certain set price. Now, there are two real types of options. The first one is the call option, and a call option allows you to buy an asset at a future point in time at a set price. So if you imagine that I want to speculate on the price of Bitcoin, and I want to speculate on the price of Bitcoin at a future point in time, I go to, let me just go here. I go to Deribit and I go to the option section and I find the date at the future point in time where I want to speculate. And let's just say, for argument's sake, that I want to speculate on options at the end of this year. I go to December 2023. I look for a strike price and I say the future point in time, what is the Bitcoin price? I say, let's say the price is 31,000. And then I can buy and sell options at a future point in time around Bitcoin. So I can buy an option. A put option is the right to sell an asset at a future point in time. And I guess the big question that you guys are asking is, well, why the hell would I use an option when I can actually just use futures and I can use leverage and I can go and I can open an account on Bybit or any one of these futures exchanges and I can just take 10x leverage or 15x leverage. Well, there is a very good reason, or a whole lot of good reasons why you would use options. One is if you want to hedge or protect your portfolio. And that means that if you've got a portfolio, if say you've got Bitcoin in your portfolio and you want to hedge the price, say you're worried that the price of Bitcoin may go down, well, then you'd go to Deribit and you'd buy a put option, which is the right to sell your Bitcoin at a certain price at a certain point in time. And then if the price of Bitcoin does go down, you've effectively hedged your portfolio against the price dropping down. Now, you could also use options to speculate. So you could buy a call option on Bitcoin to speculate around the price going up or down. And you could do this without getting liquidated, because unlike futures, options don't allow you to actually get liquidated. You can only lose the price that you pay for the option. You can also do it to get exposure to an asset. So if you just want to get some Bitcoin into your portfolio pretty cheap, you can use options to do it, or you can actually sell options and just collect the fees. So there's good ways to collect options. Now, all of this was covered in our last options tutorial, which I've got links to below. You guys can go and watch it, and I strongly suggest that you do that. Other than that, I want to get into the actual option strategy. I want to get Richard and I want to get Shane on here. They're from a group called Rogue Trader or Rogue Traders. They effectively teach people how to use options, institutional clients, retail clients. Guys, welcome back. Nice to see you guys.
Thank you.
Good to be here, man.
I don't know about you guys, but I was dying of boredom with all this lack of volatility on the crypto market. So that 29,500 to 31,000 range will forever be ingrained in my memory as like one of the most boring things that's ever happened to Bitcoin. As options traders, I guess you guys must have got like pretty bored. Like the options there's no volatility and options become pretty boring, right?
So we are both naturally option sellers by nature, although we do buy options from time to time. And so for us, what we've seen is a general trend in the reduction of volatility on options, and as a result, a general trend in the reduction of implied volatility, which means a reduction in the price of options. Now, as sellers, that's good for us because we sold options when volatility was higher. Volatility drops, therefore the price drops, and therefore we've sold high and we're buying back low.
Okay.
Yeah, it's all reverse, right? But of course, as the period of low volatility goes on and on, the danger that we then need to make more money, and therefore we have to sell more options. And now we're selling at what are becoming close to the lows, or at least that's the danger. So we have to be more careful.
Now that Bitcoin's broken down below the 29,500 level, that's increased the volatility and therefore increased the price of options. So the price of options becomes a bit more expensive.
So the current market, $1,000 move isn't really seen as a big event. So you may see a small uptick in the price of options tomorrow morning when all the market makers re-evaluate where their books are. What's really going to make it go is if we get like a $4,000 or $5,000 sell-off, or a $3,000 sell-off followed by a $4,000 rally. Then you'll find that all the guys who sold puts will be liquidated on the way down, so they'll be buying puts and driving the price up, and they'll be selling calls on the way down, and then as it bounces, they'll all get liquidated, and they've got to all buy calls to cover their positions, and so they'll drive all the prices up. And so it's those kind of reversals that really start injecting value into the options market. And that's actually what we're actually anticipating around FOMC or just after. Okay.
Whoa. Now you've opened up a can of worms. So you're expecting huge volatility. You're expecting huge volatility around the FOMC period. Why are you expecting so much volatility? Where's the writing on the wall? What am I missing?
Volatility is at historic lows on Bitcoin. Now, look, the history of Bitcoin isn't that long. There's only been options on Bitcoin for about 4 years, so the history isn't that long. But we've never seen volatility at these low levels and at these sustained low levels for this long.
Have you got a chart that shows this, Richard? Have you got a chart that is it somewhere that where our viewers can actually connect? I'd love for our viewers to learn where you're checking this volatility and where they can check the volatility.
So if you look on Deribit,
I'm going to put your screen up. So there's your screen on the screen.
Okay, great. If I'm shared, so there are two. So if you press this little button with 9 dots, I've no idea what they call that. But anyway, if you look at the volatility index, DVOL, that is a running average of the at-the-money volatilities of the 1 month option, or as close to it. I'll get to that in a second. If you look one below, that's the historical volatility. So if you look at the historical volatility, which is the standard deviation of the returns of Bitcoin over the past 15 days, I think it is, and we can see that the actual volatility of Bitcoin has got down to 28%. So 28%, just to put that into perspective, is about the volatility you'd expect on a slightly subpar stock on the NASDAQ or the S&P. So Bitcoin has become as stable an asset as a mediocre share on a traditional stock exchange in terms of the actual amount of movement we see in it.
Happy about that because people can
that's unprecedented. Normally this number is more like 60 or 70. And then the DVOL index measures the implied volatility in the prices of the options. And we could do a whole course on this. In fact, we do. But and what we're seeing here is that so this is essentially the driving force behind the price of options, how expensive they get. And you can see that over the past, I don't know, year, or this is six months, there have been the general trend has been down. There's been the occasional event. We saw the $1,000 or $5,000 run up about a month ago while I was on holiday, which increased volatility up to about 55, 60-ish maybe, which is still historically not high, but it was high enough that we all thought, okay, quickly, let's sell vol. So we all started selling options. And of course, the result of us all selling options is the price comes down and down. And now we've got 3 days of sitting on the bottom of this sort of line, and I've never seen it before. I've never seen it get so low so quickly, resist going up so much, and it just tells me that there is loads of people, or whoever's out there in the market, realize that the only way to make money out of Bitcoin right now is to sell options on it, and more and more people are jumping on the bandwagon. And as there are more and more sellers, they're crushing the implied volatility. That can only mean one thing: that there's lots of people out there who are more and more long short volatility, which means that if volatility starts to rise, these guys are all going to be on margin call or having to cover positions to avoid losses, and they're all going to be panic buyers of options. So I'm not saying that it's the FOMC that will trigger this, but the FOMC is the kind of event that could trigger this. So I like to be prepared for that, but without actually having to pay the bill.
Okay, so before we get into what that could mean, Shane, what are your views on this week in terms of volatility? I know you're also watching the options market. You also told me before the show it's a very, very, very big week. So walk me through what you think this week holds.
Yeah, I don't know if we're going to get a big vol spike, but if it's going to be any week, it's going to be this week, because I was mentioning that this week we've got nearly half the market cap of the S&P reporting, which is crazy. Like nearly half the market cap is reporting. So that's going to potentially move the market. We've got the FOMC on Wednesday. We've got the ECB, so the European equivalent, on Thursday. We've got the Bank of Japan on Friday. Now, none of those things might not do a thing, but if they do some unexpected things, I expect this week could be a bit crazy. I personally don't think a heck of a lot is going to happen. I'm hoping we get some moves, and there probably will be some, but do I think there's going to be a 12 or 15% move in cryptos? Probably not. I hope it does, but I don't think that it will. Now, Ran, when you were showing your chart there of Bitcoin breaking down, It could be part of a breakdown. You know, hey, we're stuck in that little range, like you said, for a month. We're all bored stiff, but that is also a classic bear trap. You know, you kind of bring it down. You trigger some stops, you trigger some orders, and then just before you know it, we're at the top of the range. If we go up to the top of the range, and it was a true bear trap, we're going to go up. But I personally, I'm a little bit more inclined to the downside. I think that we're more likely to probably head down, but I don't rule out the fact that this could be a bear trap.
I mean, you've hedged your bets very well there, like a politician. You said, look, it might be a bear trap, but you're also more inclined that the market's going down. Tell me why you're more inclined to believe that the market's going down, because I think that's what I want to try and get into your head.
Well, first of all, I'm a contrarian trader usually, and I don't care which way the market goes. I trade the market, and I never try and predict. Sometimes I've got hunches, and I'll play the hunch, but I don't try and place bets on we're going up or down. For me, it doesn't matter. And one thing I will want to say to your viewers too is, hey, even if you don't get it right, let's say you're sitting on the fence, you don't know what to do. That's okay. You can make money when it goes, but sometimes it might be better to let the market decide which way it's going to go and then jump in once everybody's all panicked. Sometimes that's the best opportunity for making money. So don't kick yourself if you miss it. But the other thing too is, when markets break, they go down faster, a lot faster when they go down versus when they go up. So I think that if we're going to go, and we're going to make a hard move, it'll be a hard move down. If we move up, I think we'll go to the top of that range at most.
Oh, okay. Not everyone's very convinced that we're going to break that 31,500 range. It's almost become like the psychological barrier that people are going, well, we're not going to break it. We can't break it. No amount of good news can break it. I think that's where everyone's going to get tricked, because what I do know is that when everyone has a certain view about a market, the market usually makes everyone look like fools. All right, let's go into the strategy and say, look, if I'm a beginner and I want to be, and I know you guys are super advanced, and I'm going to let you have your advanced moment towards the end. But if I'm a beginner and I want to trade options, I want to start trading options. What is a good strategy ahead of FOMC? Walk me through it if I'm bullish. Walk me through it if I'm bearish. Rich, you can start. Your mic was on mute. I think you've unmuted yourself. Tell me, what do I do? Where do I go? Walk me through the trade. I can't hear Rich.
Are you there, Richard?
Your mic's muted. Just unmute yourself on the dashboard. I can't unmute Richard. That's the problem. Because he unmuted himself. It's on the stream. Just smash the. There we go. Okay. We should be able to hear you now.
Yeah. Sorry, I had a terrible noise in my headset from a. It's
okay. So walk me through, if I'm a beginner, what a good options trade may look like. Not financial advice. We're not going to hold you to it. Just walk us through how to do it. What you would recommend.
Rather than risk financial advice, shall I show you what I've done with my own test account?
Fantastic. Let's go.
I'm sharing the screen here.
Yes,
so ignore the red bits at the moment. Just look at the two green positions I have. So I bought the 29,500 call.
What date? So what date options are you trading?
This is the 11th of April.
11th of April.
So it's roughly two weeks, roughly just under 2 weeks.
Wait, 11th of August, you mean?
Sorry, August. That's right. About 17 days. And I've also bought the 28,500 put. So just considering those two positions together, that's called a strangle. And that's a long strangle.
Walk me through the position again. So you bought a.
I bought the 29,500 call.
Okay.
So that's the up bet. And I
that's
bought
the right to buy Bitcoin at 29,500 on the 11th of August, and you bought I bought the 28,500 put. Okay, so explain to me what the logic is behind that decision.
So the logic is that my feeling is it's likely that we're not going to be here in 14 days' time.
Okay. So and down.
So I'm agnostic as to whether we're going up or down. I actually personally think we're more likely to go down than up. And my feeling around that is kind of macroeconomic and also general zeitgeist, lack of good news, lack of new investment, plus nobody's got any money. And but that's not really what drives markets in the short term. I also think we had a massive run up about a month ago, $5,000 run up in Bitcoin, and that hasn't been consolidated, hasn't been tested. And I think there's an opportunity for the market to want to go and sniff where the bottom really is, which sounds a bit chartist. I'm normally not a chartist, but I do kind of feel this isn't right. This just feels toppy. Just a bit of the old spider sense.
But in this trade, you're indifferent between up or down. You're just saying I want movement, right?
In this, if you just consider the long legs of this trade, yes, that's correct. And then I did a bit of expert stuff on top of it, which I'll mention whenever you give me permission to.
Okay, so for now, what you're saying is, if I look at my dashboard, you bought a 29,500 call. You paid, I'm guessing, somewhere around $700 for that.
Let me quickly check the screen. It's roughly, $700. Yeah.
And you sold a put at 28,000, so you paid another. You bought a put. You bought a put, so you paid another $520 more or less, right?
Yeah.
So in total, you've spent $1,200. Explain to me when you start making money on this trade.
So if just considering those legs of the trade, I would start making money if Bitcoin went below 27,300 or above. What is it? 30,700. Yeah.
You start making all of that money, and the amount that you lay down. So you laid down $1,200, and you make unlimited up and unlimited on the way down as long as Bitcoin goes up or down. The only time you don't make money is if Bitcoin stays in the range of between 28,500 and 29,500, right? That's the only time you don't make money.
Well, plus the $1,000 I spent, yeah. So it's actually more like 27,500 to 30,500. So it's quite a big range where I don't make any money if I just do that trade naked. Yeah.
Okay, and if we get huge volatility and Bitcoin goes up or down, the amount of money that you can make is pretty much, I want to say unlimited. Obviously, there's a limited, but you get all the upside and all the downside, and the net amount that you can lose is the $1,200 that you spent. You can't get completely liquidated. The most you can lose is the $1,200. It doesn't touch the rest of your portfolio. Shane, what do you think of Richard's trade? Sounds to me like he's being a bit conservative, but I'm gonna put it into your court.
Well, I suspect he's got a little bit more complexity on top of there, which he'll reveal later, because both of us never really buy naked calls or puts. The only time I do that is when I don't want to get technical, is when I'm negating tail risk, waiting for a multi-standard deviation event. So we don't need to get into that. But for the most part, I don't just, if I think, hey, XYZ is going to go up, I don't just buy a call. Now, the only exception to that rule is, again, high nerd stuff. If it's a high gamma trade where it's near-term expires, so if I'm buying an option that expires today or tomorrow or maybe this week, then I'll go in. If I see a big move down, I think there's going to be a reversal, I'll buy that call naked right then and there, and boom, looking for a big gain on that. It's more of a scalp. But for the most part, for a position like this, who wouldn't do that? Now, I've got no problem with a long strangle. If there's any time this thing's going to move, it's probably going to be this week, but there's never any guarantees of the market. So he's positioned himself. He's going to make money if it goes up significantly, if it goes down significantly. I suspect he did this as a spread. So he would have capped his profit on either side, but it also would have reduced his cost. So I like that trade.
I'm gonna let him degen in a second. In fact, okay. So Richard, I get it. The basic trade is, if you think there's going to be volatility, buy a call and buy a put, which means that you're basically betting on the fact that there's going to be some volatility, and any volatility actually make money. Now, tell me what else you do.
There's a couple of layers to this. So the first thing is that if you look at either your screen or mine, you'll see that I paid 32% volatility for these trades.
Okay. Because that was the price of the option. What you're basically saying for the newbies here, you're saying when you bought the option, the volatility, the implied volatility was 32%. Now the volatility has come down since then. It's now 28%, right?
So the real volatility, the realized volatility in the market is 28, but the implied volatility in the option price is 32. But actually, in the end, we're just trading the implied volatility. So okay. I think just as a tiny background, so for your beginner viewers, the implied volatility is one of the inputs that you put into the equation to make the options price. And you can just think of it as the level of fear in the market, or the level of fear or greed in the market. Mm-hmm. And at 32% in cryptocurrency, we're saying nobody's fearful and nobody's greedy. Mm-hmm. So these options that I bought, I paid $1,200 for. Mm-hmm. If volatility were to double, then even without me being in the money, these options would be worth double. So actually,
okay. So you're actually trading the option. You're not worried about whether there's going to be you're just trading the fact that there's going to be some kind of volatility, and as soon as there's volatility, the price of the options changes.
That's layer one, yeah. So that is I'm seeing volatility at a historic low. I've got an FOMC coming up. I've got people complacent. I'm thinking, okay, let's buy some vol, because if nothing else, at some point there's going to be a spike in vol as people get scared or greedy, and people are going to be willing to pay more than 32 vol for these options. They might pay 40 or 50 or 60, and I'll just sell and I'll cash in.
Okay. Wow.
That's layer one.
So I think the interesting takeaway here is most people think of this in terms of price. Hey, I bought it at this price. I bought it for $500. It went up to $700. I made $200. That's cool. But Rich is saying, no, I bought it at 32% vol. If it goes up to 45% vol, the price doesn't have to move. People can just all of a sudden get fearful. The Fed's going to make a surprise announcement about cryptocurrency, and everybody gets scared. The price of crypto might not change, but the premiums on those options will go sky high, and you can sell
the same options that he bought. You can sell them at a much more expensive. So you're actually looking at the price of the specific option. So I just want to, just for the viewers, just for fun, I think what we should do is say, look, let's just earmark these numbers. So let's call it between $701 and $716 is or let's say $700 more or less is the price of the 29,500 call, and the price of the 28,500 put is about $520, just give or take between the bid and ask price over here. And we'll watch it on the lead up to the FOMC. I'll actually bring it up on my show. We'll watch it on the lead up to the FOMC and just see how much you can do here. Now, I want to ask you a question here, Rich. Is there enough volatility? Is there enough volume here to actually make serious money? Like for me, if I'm thinking to myself, how many options do I have to buy at $500 and sell them at $550 to actually make money? It needs to be thousands of options, right? If I want to make 100 grand, I got to buy like 2,000 options. Is there a market? If I want to buy and sell 2,000 of these options right now, because it doesn't look like it when I look at the bid ask at the spread here. At the size, this is the size column over here. Doesn't look like I could actually smash it out the park here and make hundreds of thousands of dollars. What am I missing?
So you're looking at the screen price. So the prices here are being made by market makers who are obliged to quote every single option and almost every single strike continuously. Mm-hmm. And you can imagine that's quite a capital-intensive, risky proposition for market makers. There are other secondary markets that feed into Deribit. So one popular one is called Paradigm, for example, and that's a market that's specialized for, you'll go on there and say, I want to trade 2,000 Bitcoin of some option, and market makers will look at your trade and they'll offer you prices. So they'll do what's called RFQ, request for quote, and then you'll agree that trade off market, and then it'll get actually booked onto Deribit as what they call a block trade. And there are people doing 2,000 Bitcoin, 5,000 Bitcoin trades all day long. Those markets are huge.
If I'm a retail investor and I'm watching the show and I'm saying, look, I want to trade 1,000 of these options. I want to buy 1,000 options right now. I've got my $500,000. What do I do now? What's the next step?
So you go and put an offer in or a bid in Bitcoin at the money in the mid for size 2,000 Bitcoin. You'll find people will come and take your action for sure.
Another thing. Sorry, Ran, just another thing I'll mention is if you're looking at a weekly or a daily expiry, there's going to be a lot less volume there, a lot less open interest than if you're looking at a monthly expiry. And if you get deep out of the money or in the money, there's not as much interest in those options. So you just depends on where you're looking. Sorry, Rich, didn't mean to jump in there.
But I think what you guys are saying is that as an investor, I shouldn't worry about the fact that I'm not seeing all the liquidity on Deribit. It actually is there. As soon as I put my bid on my offer, and my bid on my offer is not priced exactly as the market's pricing it, one of the arbitrage traders or the market makers will come in and swoop on my bid.
Very often, there are what's called like iceberg orders in the market between the bid and ask, and you can often go and place an order between bid and ask, and you'll hit one of those icebergs and get traded. There's much more liquidity there than you can see.
All right, so I'm going to summarize and I'm going to say the following. Rich, you are saying you are betting on volatility above 29.5, below 28.5, plus the $1,200 that you spent. You're also betting on volatility because as soon as that volatility comes, the options that you've bought are going to increase in price, and you're then going to be able to sell those same options at a better point in time. I'm going to follow this the whole week on my show, and I'm going to just quickly, I'm going to call it the Richard trade. So I'm going to call it the Richard trade on my show. Remind me, guys.
Before you do, then let me just quickly explain layer 2.
Okay, tell me about layer 2. That was layer 2, but okay, tell me about layer 2.
So layer 2 of the trade is so layer 1 is I've got the layer 0. I've got the price action. Layer 2, I've got the volatility action. Layer 3, I don't want to pay for it. So I've actually got the market to pay me to be in that trade
by selling puts and selling calls.
By selling puts and selling calls. And so what you can see is that above the 29,500 calls, I've sold 3 times as many of the 30,500 calls, which actually means I get a net $100 credit on the trade. Actually, a bit more.
Okay, but hold on. What if the price? What if the price? So okay, so you sold calls. At 30,000. What did you say? 30,000.
30,500.
Okay, by selling calls, that means you've sold someone the right to buy from your 30,500. So what happens if the price goes to 41,000?
Well, I'll if I see the price moving that quickly, I'll hedge with futures. But if the price goes against me, then what I'll do is I'll pick up those 30,500 calls and I'll roll them out to a later week or a later month, and eventually I'll roll them out to a higher strike, and eventually I'll get away without paying for them. But meanwhile, I'll be picking up all of the positive action from the 29,500 long calls. So I'm then now getting paid to avoid paying my debts in the market.
Shane, what do you think of this, and what have you done?
Well, I think this is what we do sort of day in, day out is, we, like I said, we never usually will buy a naked call or a naked put. That's sort of for the chumps. That's the guys who go to the casino, right? They know what they're doing. There's nothing wrong with it every now and then. Sure. If you're new, hey, try that out. It's no problem. Try it out. You're new. But over time, you'll find that it becomes too expensive because when you buy calls or buy puts, you have to be correct on both timing and direction. And that's a tough thing to do directionally. So this way, you either reduce your price or, as Richard's done, he sold what's called a ratio spread. The market paid him to do it. Now, if it goes against him, we just manage that trade. Like we said, it's called rolling. We roll it out and up. There's other things we can do with that trade at that time. But yeah, and I like this trade. You know why? Because I think if it goes up, I don't think we're going to blow above the previous highs, like 31 or 32 or anything crazy like that. So I think this is a great trade. It's short dated. These options are going to decay very quickly. I think it's only about 16, 17 days to expiry. On the downside, sorry, Richard, where did you sell those puts on the downside? What price?
They're 28,500, so they're a bit close.
Those are a bit close. You bought the puts at 28.5, right? And you sold?
No, I sold the 29.5 and I bought the 28.5.
Oh, okay.
Sorry, I bought the 28.5 and I sold the 29.5. No, hang on.
No. You got to take a look at the screen.
I bought the 29,500, the higher ones, and I sold the 28,500, the lower ones.
That's the call.
No, I didn't.
No,
I'm talking nonsense again. 28,000. I bought the 28,500 puts, and I sold the 27,500 puts. See, I don't even remember what strikes I buy and sell. I just go by the vols. But okay.
Yeah.
I think what we're going to do. It's getting a little bit technical. But what we're going to do is I think we've got this all down. I think we're going to bring you guys back here next week after FOMC. So after FOMC, either there's going to have been volatility or there's going to have been no volatility.
Ran, just to summarize, what I'm going to do is I'm probably going to stay out of this. Now, if I see the volatility increase right before Wednesday, I'll play the volatility crush, or I'll sell the volatility, I'll buy it back lower. But I don't expect that to happen. I'm hoping something stupid happens. We get a big move up or down, because then what am I going to do is I'm going to take the other side of that trade. So I'll let the market move first, then I'll come in. That's my strategy for this week.
We'll only know next week whose strategy was right and whose strategy was wrong. Guys, I will catch you guys again next week. Good luck. And to the audience, listen, as I said to you guys, go and get yourself a Deribit Account KYC. You immediately get $50 deposited into your account. Then just use that $50 or deposit another $50 and just use it just to start learning how options work. Maybe you'll lose, maybe you'll make, but at least you learn how options work. And then you become like these degens over here who seem to know the game like you do. So listen, I'll see you guys again tomorrow. Until then, trade well, my friends.
Thanks, man.